If somehow Iran got a nuke and were to launch it, that would be really bad. If somebody dropped a nuke on Iran, either of those events, I think, could be a catalyst for a much higher gold price. The gold price could be, who knows, 6,000, 8,000, 10,000. It's certainly not an outcome I'm hoping for.
So now, of course, there's been a ton of talk about de-dollarization, the BRICS nations trading using gold instead of US dollars, China rolling out a yuan-based payment system.
And when the gold price drops, that's ultimately what it is. The dollar is becoming more valuable. The price of the dollar is inverse to the price of gold. It's not really a choice. You're not saying, I think the dollar is better than gold. That's not, nobody's making that value judgment. You're just saying, okay, I have to. And if you don't do it, the margin clerk will do it to you. Real estate in Dubai right now, not only is the price lower, whatever they're quoting the real estate index, if any deals are getting done, but I'm sure the bid-offer spread is much wider than the normal. And gold, that doesn't happen. And so that makes gold attractive for people to buy for situations like this.
Do you expect it to continue as a potential sell everything moment looms? And if it becomes an extended affair, how do you expect it to impact gold and silver prices, if at all? Silver market here, because last time I had you on the show in early December last year, you said that silver demand was relentless. And since then, we saw the metal soar to triple digits. At the time of that recording, it was around $60. It is now sitting around $80. Are you still seeing that relentless demand? And do you expect another leg up in this silver bull market here in 2026?
Supply and demand conditions in silver are still tight. Not as tight as they were at 60, which is, to be expected. Usually rising prices are the cure for, tight demand. But yeah, I don't see a return to 30 or 40 or anything like that. I see possibly retracement to 60, but I see bullish pressures on silver and gold.
Well, let's talk about the gold market as well, because here we are, as we discussed at the top of the show, on the potential precipice of this conflict expanding. Debt and deficits continue to skyrocket around the world, and all the drivers that brought us to over $5,000 are still intact. Are there any catalysts on the horizon in particular that you think could cause us to enter the next phase of this bull cycle for gold?
The real signal here isn't silver at $80 level. It's what the market is quietly admitting about scarcity. As Keith Weiner points out here, tight supply is easing slightly, yet prices remain elevated, suggesting demand is structural, not speculative. A potential retracement to $60 isn't bearish. It's a liquidity reset investors saw in past cycles like 2020. Meanwhile, gold holding above $5,000 despite rising rates and deficits shows macro forces, debt expansion, and geopolitical risk are overpowering traditional valuation anchors. Next, Keith Weiner discusses what could actually trigger the next explosive phase in gold.
If nuclear weapons come out or anything, when people talk about escalation, I'm certainly no military analyst. I'm just a layman, watching all this stuff, and I have about as much expertise on, vaccines and Jeffrey Epstein and geopolitics and now military analysis as the next guy. But in terms of escalation, I think the one thing that one could have been concerned about at the beginning of this was, is the whole Middle East going to, join the side of Iran, and then you have a real, conflict, and it becomes very intractable very quickly. But Iran went and attacked everybody. Even including Turkey. So I don't see them having a lot of friends right now, and at least in the region. Now, Russia and China are sort of friendly, but I saw a meme that said, Russia sends their thoughts and China sends a truck full of their prayers. They don't seem to be getting a huge amount of, actual, support. So in terms of escalation, I don't know. Maybe I'm completely blind to that. As I said, my focus is obviously precious metals, not military, but I would say no, it isn't escalating in the sense of involving more and more countries that turns into a global war.
The market keeps pricing in global war risk, but the alliances aren't lining up that way. As Keith Weiner points out here, escalation fears are overstated because Iran's actions have isolated it regionally, limiting broader military participation. That matters for investors because gold spikes typically require systemic escalation, not contained conflicts like we've seen so far in 2024 to 2026. The real disconnect is between media narratives of global war and the lack of coordinated state involvement that would justify sustained panic buying. Next, Keith Weiner unravels what kind of escalation would actually move gold meaningfully higher.
That doesn't seem to be, in the case of both Russia and China, seem to be, if not content, at least conceding that if Iran goes down, so be it. They have distance and plausible deniability and write it off and, move on. And I hope it stays there, obviously.
And then so you're saying that if the conflict escalated to a greater degree, pulling in more people, more different countries from the Middle East, if it went nuclear at some point, you think that could be a major catalyst for the gold price?
I don't see, I was just sort of going through my thought process, I don't see more countries from the Middle East coming in, certainly not on the side of Iran. Now, they may or may not come in on the side of the U.S. They're certainly pissed. I mean, Iran launched enough things, hit some of their oil stuff, hit their airports, hit a bunch of other things. They're pissed off at Iran. They're not going to come in on the side of Iran and be fighting the U.S. That I don't see. Now, if somehow Iran got a nuke and were to launch it, that would be really bad. Or if somebody dropped a nuke on Iran, either of those events, I think, could be a catalyst for a much higher gold price.
The uncomfortable truth is that gold's biggest upside may depend on scenarios nobody actually wants. As Keith Weiner points out here, without broader regional alignment, the conflict lacks the scale needed to drive sustained, safe haven flows. That means current gold pricing already reflects elevated risk premiums, and further upside likely requires extreme catalysts like nuclear escalation, events that would disrupt all asset classes, not just metals. For investors, this creates a dilemma, positioning for tail risks without overexposing to unlikely outcomes. Next, Keith Weiner discusses why even thinking this way reveals something deeper about market psychology.
But this is one of those things I remember years ago on Twitter, and I kind of really, kind of lost it when somebody said, because North Korea was threatening to nuke South Korea, and they were hinting that they had missiles that could reach LA. And then there was some idiot who said, that would be good for gold. And I'm like, you bleep and bleep and bleep. You're talking about like nuclear annihilation, and the only thing you can think about is number go up. I mean, normally I say be careful what you wish for, but that's like next level, And the same thing here. I mean, if that happens, then, which I don't see likely, I have to say, but if that happens, then, the world takes a turn towards a darker, place. And yeah, the gold price could be, who knows, 6,000, 8,000, 10,000. I mean, I don't know. That's certainly not an outcome I'm hoping for. Say the least.
Yeah, that's a really good point. And I don't think there'd be that many, people in their right mind who would be celebrating their gold going to 10,000 amidst a potential nuclear conflict.
There's a dangerous mindset in markets where catastrophe gets framed as opportunity. As Keith Weiner points out here, extreme upside scenarios for gold often come tied to systemic breakdowns that would make financial gains meaningless in real terms. History shows that during crises like 2008, liquidity, not profit, becomes the priority, and even gold gets sold initially. The fixation on price targets like $10,000 ignores second-order effects, currency controls, market closures, and real-world instability that investors can't hedge easily. Next, Keith Weiner unravels how narratives around money itself are being misunderstood globally.
Now, I want to read something you wrote on X recently. It got a lot of attention, actually. You wrote, I took a taxi in Oman. Driver didn't accept credit cards. I said I did not have any reals. Offered him dirhams from neighboring UAE. Dollars, he said. Folks, at the same time that everybody on X is saying de-dollarization, every cabbie in the world is saying dollars. So now, of course, there's been a ton of talk about de-dollarization, the BRICS nations trading using gold instead of US dollars, China rolling out a yuan-based payment system, Iran now recently announcing they're considering to allow passage through the Strait of Hormuz if the vessels have transacted in yuan for their cargo when it comes to oil tankers. Is this all noise, more noise than signal in your view? And how are you currently looking at the overall health of the US dollar in the world today?
Health is the wrong word. I would say how the world's monetary system is wired. So I mentioned earlier that every commodities trading house is, craving dollar, seeking more dollar liquidity. And meanwhile, every cabbie in the world, and I'd written on X, or at the time Twitter, years prior, I think that was pre-COVID, I had a taxi in Switzerland, maybe it was in Liechtenstein, I think actually, to get me to the train station, to get me to Switzerland.
The de-dollarization narrative sounds powerful until you see how money actually moves on the ground. As Keith Weiner points out here, global demand for dollars isn't ideological. It's functional, embedded in trade, debt, and liquidity systems built over decades. Even as BRICS discussions accelerate in 2025 to 2026, real-world transactions, from commodities to informal economies, still default to dollars because alternatives lack scale and trust. The gap between geopolitical headlines and transactional reality is where most investors get misled. Next, Keith Weiner discusses why dollar demand may rise even as confidence in it falls.
And, same thing. Maybe I'm just an idiot, but I just tend to assume that credit card will work everywhere. And then that tax, they didn't take credit card either. And so that particular one, I still remember, was 20.6 francs. And the franc was at that time it was like $1.02 or something like that. So it should have been about $21. I don't know. And I didn't have francs and I didn't have change, but I had a $20 bill. I took out the $20 bill. He didn't really speak English much, but he smiled and was happy that 20 we're all good. Even though it was a bit shy of the amount. And you think this is Switzerland, right? I mean, of all the paper currencies that everybody would talk up as being the best paper currency, everybody would say this was franc. And here in Switzerland and Liechtenstein, they use the same Swiss franc. They're part of the monetary union or whatever. Absolutely happy for dollars. Now here in Oman, or there in Oman, I'm not in Oman anymore. UAE is the neighbor. And there's a lot of, people going back and forth for business and holiday and all that.
The narrative of strong alternative currencies quietly breaks down in real-world transactions like this. As Keith Weiner points out here, even in Switzerland, often viewed as the gold standard of fiat stability, people still default to dollars for convenience and trust. That reveals a deeper truth. Global currency preference isn't about theory or policy. It's about liquidity and acceptance in everyday exchanges. Investors betting heavily on rapid currency displacement are ignoring how deeply entrenched dollar usage remains at every level. Next, Keith Weiner unravels why this dependence actually increases systemic fragility.
They're the same basic ethnic group that they broke into different kingdoms, but it's not, it's kind of like, North Carolina versus New Jersey. I mean, they're not really different. A little bit of a different accent, but, and there's no question that currency would be useful to him in Oman. It's not like if somebody gave you a Hungarian forint in Canada, it's like, what are you going to do with that? It's the neighboring country. There's a lot of trade between the two. It's not going to be a problem for the guy. Dollars. And that's how the world is wired. The dollar finances every major project, every major corporate enterprise, every government, every infrastructure project. It's all dollars. There's no market. You want to build a $20 billion, dam and desalination and this and that and the other thing. There's no market for that bond other than in dollars, maybe euros, but everyone in dollars. And once, I've written a lot about this, but once the debt is incurred, then there's a relentless craving for dollar revenues. More or less in perpetuity. And so the more dollar debt there is, the more demand there is for dollars. Now, that's not healthy. That's not good. That's not saying the dollar is a good currency. It's saying the debtors are drowning, is what it's saying. And they're desperately, clawing at air to try to get some. And they're drowning in it. But what it means is the dollar perversely has a high value that can go higher. And when the gold price drops, that's ultimately what it is. The dollar is becoming more valuable. The price of the dollar is inverse to the price of gold.
What looks like dollar strength is actually global dependence disguised as resilience. As Keith Weiner points out here, the system forces demand for dollars because trillions in debt, from infrastructure to sovereign borrowing, must be serviced in dollars regardless of economic conditions. This creates a feedback loop where more debt issuance increases future dollar demand even as confidence in the currency erodes. For investors, this explains why the dollar can rise during crises while underlying risks quietly compound beneath the surface. Next, Keith Weiner discusses how this paradox directly impacts gold's long-term trajectory.
The war in Iran and its potential implications for precious metals markets, because we've seen both gold and silver sell off somewhat since the conflict began. Did that take you by surprise? Do you expect it to continue as a potential sell everything moment looms? And if it becomes an extended affair, how do you expect it to impact gold and silver prices, if at all?
There's so many different forces. You have the trillion-ton force pushing this way, the 0.9 trillion ton force this way, but there's other forces. So let's tease it out. Number one, there is a scramble for dollar liquidity. We talk to, let's say, big trading houses, for example, and everyone's like, we need dollar liquidity. And that could be their funding sources are pulling back on them. It could be they're getting margin calls and other things. There's a lot of different reasons why. Now, retail investors don't really understand this. They think, why is dollar the flight to safety? It's not necessarily a flight, and it's not necessarily safety. It's when you owe lots and lots and lots of dollars, and suddenly there's a threat against your ability to generate more dollar revenue to service that debt, then you have to sell assets.
The sell-off in gold during geopolitical tension isn't a contradiction. It's a liquidity event in disguise. As Keith Weiner points out here, large institutions aren't choosing dollars over gold. They're being forced into it through margin calls and tightening funding conditions. This is exactly what happened in March 2020, when gold dropped nearly 12% before rebounding as liquidity stabilized. The real risk for investors is misreading these forced liquidations as trend reversals instead of temporary stress signals in the system. Next, Keith Weiner shows what happens once that liquidity crunch begins to unwind.
It's not really a choice. You're not saying, I think the dollar is better than gold. Nobody's making that value judgment. You're just saying, okay, I have to. And if you don't do it, the margin clerk will do it to you. And nobody wants that. So they sell things. Now, it is the case, and this is one of the reasons why gold is so attractive on many levels. The bid-offer spread in gold doesn't blow out, right? So normally it's pennies or tens of pennies. The worst of the crisis in 2008, it was still pennies, per ounce, and everything else gets really, really wide. I'm sure, real estate in Dubai right now, not only is the price lower, whatever they're quoting the real estate index, if any deals are getting done, but I'm sure the bid-offer spread is, much wider than normal. And gold, that doesn't happen. And so that makes gold attractive for people to buy for situations like this. And then in many cases, it's the first thing to be sold, for that reason. Now, longer term, the desperation for liquidity is what it is.
Liquidity stress doesn't just move prices. It dictates what gets sold first and why. As Keith Weiner points out here, gold's tight bid-ask spread makes it one of the easiest assets to liquidate quickly, which is why it often drops early in crises despite its safe haven status. In contrast, illiquid assets like real estate see spreads widen dramatically, freezing transactions rather than clearing markets. For investors, this means short-term gold weakness can actually signal deeper systemic strain rather than a loss of confidence in the metal itself. Next, Keith Weiner discusses what happens after this forced selling phase ends.
And that usually has an acute phase. And then, after that, call it the hangover sets in, whatever term you want to use. And then is gold an attractive buy versus an attractive sell in a world that's, has more threats and more geopolitics and more this and more that. And even if the U.S. wins, which I think is likely, certainly they've incurred more debt, than ever before, and that makes the dollar less valuable against gold.
What markets call a recovery phase is often just the aftermath of forced liquidation cycles. As Keith Weiner points out here, once the initial scramble for liquidity passes, capital begins rotating back into gold as a hedge against the very instability that caused the sell-off. This pattern repeated after both the 2008 crisis and the 2020 shock, where gold surged following initial declines. The key driver isn't fear alone. It's the structural rise in debt, which steadily erodes currency value over time.